Hi, everyone. I'm Andre Salvi, head of North American Dealer Finance for BMO. Thanks for joining us today to discuss how volatility in global trade is affecting the auto industry. The North American auto industry supply chain is highly integrated with factories throughout the region shipping parts back and forth prior to final assembly. This can certainly make it challenging to determine the domestic content of vehicles coming off of the factory lines. Just about every client that I've spoken to who has a stake in the auto sector is trying to figure out what the tariffs mean, is trying to stay on top of the evolution of the tariffs, and is really trying to understand what this means for their businesses. So today we're thrilled to be joined by two key speakers who will provide insights on this. We have two great speakers. First, Erik Johnson is a senior economist with BMO. He plays a central role in coverage of the auto sector. And second, Tamy Chen is a BMO Capital Markets equity research analyst who covers the auto sector as well as consumer. So thank you, Erik, and Tamy, thank you very much for joining us today to provide insights. All right, with that, let's start off. Erik, I'm going to start with you. Can you provide the audience with context about how UF tariffs have changed the outlook on the North American region's economies?
Yeah, absolutely. So I think there's two dimensions you want to think about here. The first is that where we've arrived, say right now, versus where we were, in a global context, say before early April when we had that big kind of Liberation Day announcement, or in the Canadian and Mexican context, sort of in that pre kind of February March kind of period before fentanyl tariffs came in, is there's just a lot more uncertainty about what the future state of play of global market access is going to look like to the US economy, as well as what that environment for kind of capital investment looks like. And so that's a little bit of the struggle that we're left with, is no one really has a good sense of what the rules of the game are going to be, let alone for the next week or the next 3, 5, 10 years. And so that's making it a little bit more challenging to operate. And what we have to remember is the US went from an environment where the average effective tariff rate that they had on other economies in the world was in the low single digit range. And even with some of the walkbacks we've seen on some of those more kind of heavy tariffs on parts of Southeast Asia, they're still in a situation where the average tariff level is in the mid 20% range of the United States, taking us back to where kind of trade policy in the United States was in the early 20th century. And so I think that's the underlying shock we're dealing with today. And the US in particular has targeted a lot of things that it naturally doesn't produce. The US isn't making its own coffee, or growing its own mangoes, or growing its own sugar to a degree. And those are all things today that have tariffs on them. And so I think that's the challenge from not only a domestic kind of economic lens we're seeing today, but also a global one as well. And so we've gone for a world where, if you look at kind of the Q4 over Q4 kind of trend for the US, we were looking at a pretty strong year kind of prior to this kind of big envelope of tariffs that have arrived of around 2% growth. And as of that, latest kind of negative print for Q1 GDP we saw last week, that Q4 over Q4 growth number is down to 0.4%. Pretty weak year relative to what we've been used to seeing for the U.S. economy, which is really not just strong growth, but really globally exceptionally high growth, coming out of the COVID pandemic. And so that's a little bit of the challenge of where tariffs have kind of brought us. And I think the issue is when we think of the underlying assumptions that we're thinking about, playing into that backdrop, we kind of see the 10% baseline tariffs that the U.S. probably for the foreseeable future, but really that current forecast typical tariffs that it has, predominantly on China today at 145%, in addition to some of those sectoral tariffs. But if they don't kind of relent on some of those things, you're probably more likely to see a much more meaningfully weaker kind of forecast for the U.S. going forward. And if there's one kind of thing people want to be paying attention to out there right now is if you look at what's happening to ocean freight between China and the United States today, as of even last week or the week before, it was down from a volume point of view at over 60% year over year. And so that's not far off for the kind of shock we saw to ocean freight in the COVID-19 pandemic. And so the longer the US kind of continues on the path it's going forward on with tariffs, is the more that shock is going to work its way into the US economy. And so we're probably, a little more than a month away for that, fully showing up in places like the Port of Long Beach. But then that starts to have spillover effects on the US economy, whether it's in the trucking industry or the rail industry. And that in turn, means those people aren't making as big capital investments. They're not hiring as many drivers. Those people aren't earning the same labor income that they were before. And then it also is eventually going to spill over into the retail part of the economy too, when you don't have the same volume of shipments coming to big producers like Walmart and Costco, certainly, and other even small businesses more affected than those larger corporations. And so I think that's the underlying shock that's working its way through. And as we learn, right, we can turn off global supply chains pretty quickly. It's a lot harder to turn them back on. And so I think that is sort of the thing that I'm paying the most attention to. And then, if we kind of swing it back to what that means, say, for a Canadian context is, Canada's just a lot more integrated on the trade side with the United States than a lot of other economies. About 19% of our good exports go south of the border every year to the United States. The comparable figure, if we want to think of the US economy exposure to trade, only about 7% of their GDP is in goods merchandise trade. So it's a very different magnitude of exposure. And so that's one of the reasons why, just with the mix of tariffs we see on the Canadian economy today, and granted, we've ended up with a better deal than most people in this sort of bad deal world have been going. But whether it's what's happening with the auto sector in Canada on finished vehicles, or whether what's happening with steel and aluminum and some of the non-USMCA compliant kind of goods being exchanged, we do see that weighing as a little bit of a contraction in GDP in the middle of this year for Canada. So again, if we compare it to where Canada was kind of before all this tariff noise was in the picture, Canada was actually looking much more like the economy you'd expect it to be after a dramatic drop in interest rates, as we saw from the high point of 5%, down to 2.75% on the overnight rate. And so I think that was the story that we had. And now we're left with a little bit more of this uncertainty and, potentially a weaker growth backdrop heading into the rest of this year.
Erik, can you talk a little bit more about how the economic sector across manufacturers, suppliers, dealerships, how the auto sector is impacting and affecting that economic outlook?
Yeah, absolutely. So again, I think what's worth bearing in mind is, if we're just focused on, kind of manufacturing of motor vehicles and parts, on the surface, it does seem like that's a smaller slice of each economy. It's about 8% of the Canadian economy from a GDP standpoint, 0.6% of the US economy. But I think what you have to remember is there's a concentration that's very specific to different regions in each of these countries. So whether that's places like Southwestern Ontario, or if we're thinking of the aluminum supply chain, parts of Quebec, or in the United States context, when we're thinking about, parts of the Midwest, Kentucky, Texas, all these places that, participate in that broader supply chain, they're being hit not just by, say, the 25% tariff on, non-US content for, kind of USMCA compliant vehicles from Canada and Mexico. So that's, one piece we've already seen, and some repercussions, say, with Stellantis's footprint, or even, GM's footprint in Ottawa, and what that has meant kind of in Oshawa in the kind of more immediate few months here. But it is also showing up in what's going to happen to the parts sector as well. I think it's very easy to think that we make these things in very localized specific points, but the reality is manufacturing is a very big global industry, and there's a reason that we're often importing parts from different parts of the world. And the moment we kind of turn those levers off, potentially we're exposing our industry to higher costs and a little bit less efficiency. And so that's a little bit of where some producers are going to find, at least on the manufacturing side, as these auto part tariffs on non-USMCA compliant auto parts are kind of coming into effect now. And so I think that's one of the challenge on the manufacturing side. It's one thing that's likely to kind of push up prices, make it a little bit more inaccessible for consumers to kind of get into this market as we going forward. It's one of the reasons why we do see kind of volumes taking a little bit of a slip this year. As of right now, we have about 1.8 million units for the Canadian market from a sales point of view, just over 15 million units in the US market for this year. But again, we could see those kind of move down if we get, kind of continued noise on the tariff side. And so that's a little bit of the struggle. Now, if we shift to other parts of the supply chain, suppliers are very much going to feel the same pressure that manufacturers are going to go under, and to some degree even more so, because sometimes their margins are a little bit slimmer than, say, the really big OEMs. But dealers are going to have different channels that they can pursue versus, the manufacturers, right? So yes, they are going to feel some of that volume pain. And I think in addition to that volume pain, the challenge for the way tariffs are hitting the economy is it's more likely to affect the really more affordable vehicles in the market, which have been doing a little bit better as consumers are trying to make that financing arithmetic work. And so if it's hitting those kind of vehicles more so, you feel that more than if it was just kind of hitting the top end of the market on the luxury and the higher price point side. And so that's a little bit of the challenge. But again, there's still lots of opportunities, whether we're thinking about fixed op and, in the shop side of businesses that, might even see a little bit better performance if, you do see kind of slipping in volume as we saw, not even kind of 5 years ago at the start of the pandemic as well. So I think there's a little bit of that mix in dynamics depending on what sector of the industry you're in. But again, broadly speaking, when we're getting a shock that is slowing growth and raising prices, that's not a great backdrop to be operating a business in and making capital decisions in.
Oh, thank you. And Tamy, I'm going to turn to you now. I know from many conversations with clients that our clients are trying to kind of figure out the landscape, position themselves within these new tariffs and these new and evolving tariffs. And it's very difficult, obviously, to plan and to make decisions and to make business capital decisions. How has the auto industry been responding to the uncertain trade environment?
Sure, thanks. So to level set right now, in terms of the tariffs that are on the auto industry specifically, since at some point in March, there has been a 25% tariff by the US on finished vehicles that are coming into the US from outside North America. So these would be certain vehicle models from Germany, Japan, and Korea. In addition, since around March, the non-US content inside North American made vehicles going into the US are being tariffed 25%. So North American made vehicles are not getting the full 25% tariff, only a partial based on how much non-US content is in there. And then beginning May 3rd, non-USMCA compliant auto parts themselves entering the US are getting tariffed 25%. So this is how I think about effectively a 3-level auto tariff on the industry right now. So far, there's not been that much in the manufacturers' responses. So it was alluded to earlier that, yes, Stellantis earlier on in March had announced some production halt at a couple of their facilities. And then more recently, General Motors' very high volume, heavy SUV and pickup truck program. They have a facility in the US. They also have one in Mexico and Ontario that all make the same platform, and the Oshawa, Ontario facility production is coming down, and their US facility production is going up. So we've seen that as well. But by and large, aside from those specific examples, our large suppliers based in Canada, there's 3 of them that are publicly traded that I cover. And what they've all said to me is really so far year to date, not that much direct impact from the tariffs. And I think that's because the policy from the US has been so volatile up until now and might still change from here that manufacturers are in a tough place. No one's really going to make big decisions changing their production volumes or even footprint location changes when that policy by the government is whipsawing. We might start to see some more responses by the manufacturers going forward because you probably all have seen last week, the US announced some further changes to their tariff policy on auto specifically. Some of them were relief measures, some were a bit opposite of relief. But again, the manufacturers are just getting this information and are now digesting. So they have to decide, do we believe this is the policy to stay for some time? And so we should be making decisions going forward, or are we still holding in our place to see what new policies come from the White House?
And Tamy, we've heard a lot about the pull. We've heard a lot, and we've read about from manufacturers the pull forward demand for February, March, and early April. What's your current outlook on how auto sales and profitability may be impacted for 2025?
Yes, March and April vehicle sales in the US were particularly strong. And that's really just been attributed to buying before tariffs come in. Consumers in the US clearly are showing that they're assuming later this year, new vehicle prices are going to go up because of the tariffs. So you are right, these last 2 months, new vehicle sales have been very strong. When I think about the rest of this year and what impact tariffs could have and trickle into the auto industry, I see it as there's potential direct impact, and then there's potential indirect impact. So the direct impact would be actual production change decisions by the manufacturers because of tariffs. So going forward, we could potentially see more manufacturers announce halting of production on their most tariff-exposed platforms. We already saw that with Stellantis. They made an early decision with their Chrysler minivan in March already. So more of that potentially might come. There's another possibility that more examples like General Motors' Oshawa plant decision happens. So where manufacturers have multiple plants manufacturing for the same vehicle model, they may, if they can, in the US plants, increase production and then take it away from Canadian and or Mexican plants making the same thing. So we could see more examples of what GM recently did. And so all of that adds noise to the production volumes that you could see later this year. And then the indirect impact would be what amount of this tariff cost burden on the industry gets passed through to the end consumer via higher vehicle prices. We are assuming that at least some of this will happen, meaning at least some of the burden the manufacturers will look to pass through to the consumer. So then vehicle prices would mean they would go higher, and that would not be good for vehicle demand. We entered this year before there was all of these tariff rhetoric and now actual tariffs in place. We entered this year before that thinking North American vehicle production would be just slightly down versus 2024. Right now, we are assuming this year, North American vehicle production will decline about 6% year over year. So it's a pretty decent drop because we are anticipating that rest of this year, we're going to see some more material decisions by the manufacturers to change up their production. And I want to be clear, this is near-term scenario. So within a year, this is not the full scope of scenarios possible that manufacturers could change in their production footprint over the long term.
And this question is going to be for both of you, but Tamy, I'll continue with you first. And you touched on the production side of things. How realistic is it for auto manufacturers in the US to move production from overseas back to the US? Could you give us a sense for the complexity and the timing of doing this?
I think of this question as depending on the manufacturer you're talking about. So there's three main American manufacturers. So we call the Detroit Three: Ford, General Motors, and Stellantis. And they really, in terms of vehicles they make to sell in the US, they really make those within North America. So for them, the decision is not really, oh, I have vehicles being made outside of North America that I have to bring into North America or into the US. It's more what production do I have across North America? So really more so in Canada and Mexico that is not being impacted well, or meaning being impacted negatively by the tariff policy. Does it make sense to move that back into the US? And the process for that is very complex, takes a lot of time, and is very expensive. It's a bit hard to fully contextualize if you haven't seen these sort of facilities. But first of all, to build a new facility would cost up to billions of dollars. It would take years, to the point where when you're done, it will be a different government, US administration. And furthermore, where are they getting the skilled labor from in the US? We are at employment-wise already at a fairly, strong employment level, and you can't just take anybody off the street to go into these facilities. You need skilled workers. So it would take a lot of time and a lot of money. It's very complex. That is for the Detroit Three, for manufacturers who sell vehicles in the US, but they're actually importing the whole vehicle from outside North America. So there's quite a few, like the German guys, the Japanese, and the Koreans to a certain degree, depending on the vehicle make. And actually, I want to flag that this is an incremental opportunity because remember, right now, finished vehicles coming from outside of North America into the US is getting a full 25% tariff. That makes those vehicles not price competitive. It's an opportunity because one, the Detroit Three, where their vehicles are being tariffed less, they may get some market share from some of these other imported vehicles. And if these foreign OEMs manufacturers in the US want to establish production facilities in the US or even just in North America, that's an incremental opportunity for the suppliers in North America. So that's an interesting one that we will see unfold. But again, for those guys too, bringing production into the US, that part of the answer is the same as I described for the Detroit Three. It would take years of dollars and you have to try to find the labor.
Thank you. And Erik, do you have additional perspectives more from a economic perspective on the ease of shifting production?
Yeah, I mean, I think to add on to Tammy's kind of great points there is, when you just think of the volume perspective that the US would sort of be having to solve by, finding domestic manufacturing to replace what it imports. It imports roughly, 4 million vehicles from Canada and Mexico combined. So I think as Tamy pointed out, maybe there's some differences in kind of capacity utilization that, some of the more domestic manufacturers can, reposition and on a shorter term basis that requires less dramatic kind of investment and retooling. But I think Tamy's point is a really good one is, in a kind of labor market that's already pretty close, to full employment, by going out and trying to staff up further, you're often having to poach workers from other industries, from other kind of companies. And so that means higher costs. And then the second piece is, they're also importing 4 million vehicles from abroad. And so it's not really easy for just domestic capacity utilization to be able to meet that need. And so that's where they are sort of struggling in that short term to, dramatically kind of find that, macro level, kind of need for vehicles to satisfy their big consumer market. And so, in the interim, it means, higher costs as a result of, having to, still bring in some imported vehicles to, kind of meet domestic kind of consumption needs. But the other challenge there is, if we think about these longer term decisions that firms are making, they're doing them on a multi-year, sometimes even a decade-long process. And from the U.S. administration's point of view, they can't really credibly claim that the current, kind of global trade regime that they're, perpetuating right here is going to be in place for the next, 5 years, 10 years. Probably at best, they can claim maybe it's going to be in place until midterm elections in the United States in 2026. And so if I'm a big company, do I want to make a potentially irreversible investment based on this tariff wall that might be beneficial to me if I set up shop in the United States? But if a year from now, if that's unwound, all of a sudden big investment. And so I think, from an incentive point of view, it's encouraging a little bit more of hoard and hold on the part of companies as opposed to wanting to make, really big investments. And at least when we look at the, some of the indications we're getting from manufacturing surveys in the US, even, we have 4 kind of regional Fed surveys that have come out. We had the recent PMI survey as well. They're all kind of pointing to that same story that, firms are expecting prices paid to go up quite dramatically in the near term. They're expecting prices received to go up but not by nearly as much. So, margin compression there. And they're also anticipating that, either there might have to cut labor, kind of utilization in the near term, but if not, then, certainly when you look at the 6-month kind of going forward perspective, those are the kind of suggestions they're making. So much more in line with that kind of stagflation shock that we'd expect from tariffs than, a complete kind of revitalization of US manufacturing and, higher kind of scale than we were seeing before.
And Erik, how likely do you think it is that automakers outside the U.S. diversify their trade away from the U.S. market from a parts supplier relationship perspective?
Yeah, and so I think the challenge, here, again, this is like one of these things about credibility that's kind of ironic is that, right now it kind of actually makes sense if this tariff regime were to stay in place to, be setting up shop in places like Canada and Mexico because I could import, parts globally and not be tariffed on those. And so long as from, a core, kind of regional value point of view, I can still hit a 75% threshold, I'm going to get much better market access into the US potentially than other places. And so I think that's kind of the uniqueness about that, right? It seems that in those places you should have this advantage versus a domestic US manufacturing, because if I'm retooling a plant right now and I need to import, machinery and parts from, markets in China, that's just not cost competitive right now with, 145% plus tariffs. But the reality is, how long that stability is being permanent, or that sort of system being permanent or not. And I think that's where you really run into problems of pursuing that. But again, could you see if this regime stays in place long enough that, the Canadian industry is a little bit more integrated, say, with the UK and Europe than it is with the United States? Possibly, but that's, also a very costly endeavor to pursue, right? There's a reason why, producers like to set up shop close to the market that they're selling in, because, these are pretty heavy things we're building, and if we're shipping them all around the world, it gets expensive. But in the near term, I think what you could see is, if I'm a producer in South Korea, producer in Japan, all of a sudden, on the margin, it might make a little bit more sense to be supplying a vehicle, say, to the Canadian market versus the US market. And so you might end up, at least in the near term, where you're getting incrementally more vehicle supply coming into the US or coming into Canada from abroad if I can't sort of position that next shipment into the US if it's no longer tariff free.
And Tamy, what impact do you think tariffs will have on new vehicle platform launches and platform refreshes, product refreshes?
Well, even before Trump was elected and we've gone into this tariff situation, so even before then, what I've been hearing is that quoting activity, so big suppliers quoting for future new vehicle models to supply content on them, that sort of quoting activity I was already hearing was slower than, say, 2 to 3 years ago. And before Trump, the reason was because OEMs, manufacturers, have all seen that demand for electric vehicles is a lot slower in North America and even to some degree in Europe than previously expected. So manufacturers were taking a pause to think about, okay, going forward over the next 5 to 8 years, what mix in my vehicle launches do I want to be electric vehicles versus hybrid versus internal combustion engines or ICE? So there was already a bit of a slowdown in quoting for future vehicle launches. Now with these tariffs, what I've heard from some suppliers is that this has extended that slower pace of quoting. Because it's just added to overall uncertainty for the manufacturers to deal with. So I think if this keeps going on for a lot longer, the potential risk is that, let's say 3 to 4 years from now, there's a little bit of a hole or just a little bit less of brand new vehicle launches happening, because that's when you would typically see it if right now quoting activity is a bit slow.
All right, well, thank you. Well, listen, these are incredibly interesting insights and perspectives. If I could ask each of you for one key takeaway for our audience and our clients, what would it be? Tamy, maybe I'll start with you.
I think my one key takeaway is that I think this past week, Trump's changes to the auto tariffs, I mentioned it was a little bit of a mixed bag, but if I had to still characterize the overall direction of the mixed bag, it seemed a bit more positive or encouraging as a bit of a de-escalation than negative. He's removed the stacking of tariffs. So if you're paying auto tariffs, you're not also paying steel and aluminum tariffs on top of auto tariffs. And he has made USMCA compliant auto parts coming into the US exempt from tariffs. So I am watching how things unfold going forward. But the good news was those two developments. And the big takeaway here is the best outcome is that this uncertainty resolves sooner than later, because as you can see, we've been pointing out, the industry in auto cannot progress meaningfully forward if manufacturers and suppliers believe these policies are still subject to significant change going forward.
Erik, how about you?
Yeah, so I think, I wanted to pick up on something that Tamy said, and that's, we are in this environment where there's a lot of uncertainty. As you can, probably tell, Tamy and I spend a lot of time trying to understand all of this and what it means. And so I think from, an operator and a business perspective, what it means is your customers are probably, very confused what's going on. And so it's one of these times where it really is going to, pay volumes to be out there, reaching out to customers, kind of letting them know, what's happening in your business. And there are still going to be some opportunities in this near term, right? We have some products that are in a little bit better supply than others. And so you're not going to see the immediate kind of price shocks as quickly for some of them. And so it can still make sense to really market those heavily and to kind of reach out customers to say where you're going, but also, to focus on other parts of your business that you have a little bit more control over. So whether that's, the fixed stop side, the service side, those are things that, aren't as directly as affected by tariffs and might even benefit if it means, the average customer is holding on to a vehicle for longer because there's all this uncertainty about what, replacing that vehicle is going to look like this year.
Well, listen, thank you both very, very much for joining us today. We really appreciate your perspectives and your insights. And thanks to everyone for joining today and listening today. BMO is here to help navigate the current environment. You can go to our websites, capitalmarkets.bmo.com and commercial.bmo.com for additional information and resources. A video replay, podcast, and a recap article on today's event will be there soon. Also, BMO's Cross-Border Perspectives Content Hub on bmo.com has more thought leadership and is updated frequently about tariffs and the trade situation. So please keep an eye out also for future webinars from BMO. We'll be hosting the impact of global trade outlook on economies, on financial markets, on more sectors. So thank you very much, everyone. And, very importantly, please do continue to reach out to your BMO relationship managers who can help you with your unique business needs. So thank you very much for joining today. We really appreciate your time and hope you found it useful. Thank you.